Is Sydney the worst capital city to invest in 2024? Yes, you heard that right. The economic engine room of Australia may indeed be the worst capital city to place your money in right now. In this video, I'm going to go through a deep dive of what is happening to the Sydney property market right now. We're also going to look at the medium-term drivers. We're going to look at the jobs market. We're going to look at the economic performance of Sydney and New South Wales for the years ahead. We're going to look at housing supply and housing approvals. We're going to look at the rental market. Finally, I'm going to reveal 3 opportunities that I see after doing hundreds of hours of research into the Sydney property market as to where you should invest in. If you're a Sydney homeowner, a property investor, or anyone with an interest in the property market or economy of Australia, this video is for you. Okay, so what is happening right now? This is the price data. And what you see is prices have all but stopped growing in Sydney at the moment. This chart has trended up from about January 2023, the end of the last housing decline cycle, and it's been rising up since, and there's been month-on-month growth since about January 2023, but it's all but stopped growing again. This is because interest rates have been setting at this high level for an extended period of time now, and price growth has all but stopped. You can see this in lead data as well. House price growth has stopped, but also house prices over the quarter, asking prices are now coming down as well, coming off the boil a little bit, not very much at all. On other lead indicating data like auction clearance rates, you can see a slight downward trend in auction clearance rates, and it's the beginning of spring now, so you can't really say it's just a winter lull. We're into spring and we've seen a few weeks of auction clearance data as a result, and it's been fairly modest on a downward trend. Nothing that suggests alarm, but it does show that the market stopped rising and that trend will continue and may even pose small declines in the months ahead. CoreLogic have done an amazing bit of work modeling out what they expect in spring, and Sydney in particular showcases a pretty balanced situation between demand and supply. They've come up with some estimating tools to work out how much property demand there is, an estimating tool for how much property supply will come online from real estate agents just selling homes, and they've come up with a bit of analysis here, and it's fairly neutral. Housing supply, in terms of new listings, people listing their home for sale, is pretty strong at the moment. A lot of real estate agents are quoting, hey, look, we're going through a listings boom this spring, and you can see it when you're searching real estate and domain. You can see a lot of choice out there for buyers at the moment, and that really acts as a weight on price growth, and it could actually drag Sydney into negative territory on its own. You see that in this data, the total property listings, all of the listings coming online, we're up about 22% over the last 4 months. This time this year versus last year, so 20% increase in the total number of listings, 2024 versus 2023 through this period. Again, that real estate agent story there. In terms of underlying demand, you can see days on market also beginning to rise. How long it takes to sell? It's taken longer. We've got that in vendor discounting as well. But I do expect vendors to have to discount a little bit more over this spring season to get their house sold. But all of this isn't very uniform. We got a different picture depending on where you are in Sydney. This little heat map from CoreLogic, you can go on their mapping the market tool to get this. You can see different areas of Sydney performing differently. There's a pretty obvious sort of divide here. The eastern suburbs, the inner north, and the outer north areas, these areas are typically more expensive. The $2 million plus median type housing areas, they're really struggling. They're moving backwards, really. Meanwhile, those areas out west, in the middle of Sydney, the Battler Belt, those areas are doing fairly well at the moment. This is like the reverse of 2023, where the eastern suburbs and the richer, more premium markets, they led the housing recovery. Now that's spread out west, while the eastern suburbs are doing fairly poorly as a result. This is a pretty uniform story all across Australia. The more affordable markets across cities are doing better than the premium markets, and Sydney's premium market typically have higher mortgage balances, and with high interest rates, that means more and more cash flow is being taken away from them, and that is feeding through into the property price data here. Got a good number here. In the last quarter, the bottom 25% of homes is up 2%, while the top 25% of homes is up 0.4%. And if you break this down into monthly data, you'll find that top 25% of homes is the negative number that's dragging the indice down. In the rental market, you see weakness too. Sydney just posted a negative quarter in rents. That's the first time this has happened in 3 or 4 years, and it really acts as a weight against the housing market when rents stop rising. Rents nationally are up 40%. In Sydney, it's been driving much of that as well. It has really helped maintain housing values through the change in interest rates. We're at peak interest rates, but peak house prices. There was some fear, so house prices went down. Now it's straight back up to where it was. But the rent side of the story is what has driven house prices back to their peak. That has been one of the driving forces to price growth, but that is all but over, with Sydney rents now going negative and vacancy rates pushing upwards a little bit for now. So this trend may continue, and if it does continue at an accelerating rate, then this poses a big risk for the Sydney property market if rents continue to fall and if they start falling at pace. Good news for renters, but not so good for Sydney homeowners and property investors. If rents start coming down, landlords will start feeling the pinch. They ain't rising, they ain't falling, house prices are really high, they're selling, but selling a little bit slower. Some vendors have to discount a little bit more, the east is falling, the west is rising. On balance, pretty much, it's much to do about nothing. That's the Sydney property market right now, very much in balance. But what does the future hold? That's what you really want to know. What direction is the Sydney property market going to go in? For this, we use analysis of economic activity and economic change. Will Sydney's economy improve in the months ahead, in the years ahead, and how can we find this out early? That's the deep dive that we've done here. So for this analysis, I've used the CommSec State of State report. This unpacks how the New South Wales economy is doing on a number of different metrics. Now, the truth is the Sydney economy is feeling the brunt at the moment. We have higher mortgage balances, and with higher interest rates persisting for over a year now, that is causing households to rein in their spending, particularly in Sydney. Businesses, as a result, are also struggling. Fewer people are out there having dinner at night, having coffee, spending money. That then filters through to businesses who then hire fewer workers, and you're seeing that in Sydney more so than the West Coast right now. That's in the economic growth data, 1.2% for the year. That's a pretty ugly number, below the 1.5% for Australia. In a real per capita basis, it's negative in Sydney. Retail spending down 2.5%. This one's a bit ugly, worse than Australia. Equipment investment down 1.2%, while Australia is going up at 6% a year. Again, another metric that shows Sydney's economy performing really poorly. You see this across the board in employment growth, in employment, in unemployment. All of this will start filtering through. Less economic activity, more economic change towards a negative is really a negative situation for the Sydney economy today. And it's why I opened with, is the Sydney property market the worst place to invest? It's because I'd already seen this data, and this data isn't that positive. It's actually a little bit ugly at the moment, and it does suggest some risk for the future too. But what is causing the Sydney economy to slow, and will that change? This is all to do with interest rates. As interest rates begin to come down, that will help the Sydney economy more than other economies across the country. We also have the tax cuts that have kicked in. Sydney-siders have higher incomes, and these tax cuts are skewed towards middle and higher income Australians, even with the changes that the Labor government included. That means Sydney-siders are going to feel the benefit of these tax cuts and interest rate cuts, which can help spur on spending and can reverse this economic growth figure, reverse the retail spending, reverse the equipment investment, and then help promote the economy. So right now, it's bad, and you could have predicted this. You don't need to be a genius to know that higher interest rates means Sydney is in trouble, but you also don't need to be a genius to know that lower interest rates will help Sydney-siders more than some of the other capitals. So Sydney is hanging on, waiting for these rate cuts, and when they come, it should help Sydney. Now, here's the truth. One rate cut ain't gonna do all that much. Plug it into your mortgage calculators and you'll get $50 a month. Is that really gonna change that much for you? Might be a little bit more than that depending on your mortgage size, a bit more for Sydney-siders, but it's not gonna change the game for you. But what may happen is 5 interest rate cuts, maybe 7, maybe 8, 9, 10. Who knows when the rate cutting cycle starts? Who knows when it will stop? We have interest rates at 4.35%. Before we were talking about 2% as a very high interest rate. Now to get to 2%, you need a whole range of rate cuts. You need like 9 rate cuts to get back down to a 2.5% figure. We're not sure where neutral interest rates are, but there could be a lot of rate cuts when they come. If the economy keeps slowing, one rate cut ain't going to make the economy go faster. 2 rate cuts ain't going to make the economy go faster. 5 rate cuts may make the economy go a little bit faster. It may get us into a position where we're stimulating the economy, but it didn't in the 2010s to 2020 period. So maybe we need a whole lot more stimulus coming into the market. That stimulus will really change the Sydney property dynamics, and it's the real key ingredient to watch out for when assessing the Sydney market. Let's go through Sydney's job market too. I've got through this amazing statistics data set from the Australian government about labour markets all across the country. Here, let's look at the national labour market here and then go into New South Wales specifically. So New South Wales has had employment growth that is a little bit like the Australian story. 3% employment growth. The number of people unemployed has gone up 25% in New South Wales, while it's up 17% in Australia. So more people are becoming unemployed in New South Wales versus the rest of Australia. The unemployment rate gone from 3.3%, so good 12 months ago, to 4% today. May it continue to go higher. We're expecting that figure, the RBA expecting that figure to go up past 4.5% in the not too distant future. So we're going through that economic change at the moment, and Sydneysiders are feeling the brunt of this. The participation rate's still fairly strong, and employment growth has been okay over this period, considering these high interest rates and the slowing economic activity. But this unemployment story isn't a positive one. It's just a function of a slowing economy. One of the great things to look at is online job ads as well, a future indicator. What does the job market look like in 6-12 months' time? This is lead data to look at, and what you can see is the month-on-month change and the number of job advertisements really weak in New South Wales. Down 25% in a single year versus in Australia, down about 23%. So again, New South Wales doing worse than the rest of the country. Sydney doing worse than the rest of the country on the jobs market too, or the trend direction of the jobs market. Again, all a function of interest rate. Finally, and this is the most balancing factor, finally I can spread some positive news for property owners and property investors about Sydney. The population is booming. Check out what our Premier had to say about our population and the statistics behind it.
Look, the net number is obviously a big challenge for the New South Wales government.
25,000 settled in the CBD, 13,000 around Parramatta, 11,000 in the Strathfield area, followed by Cogra to Rockdale and Ryde and Hunters Hill.
Now, the reason why this is good news for property owners is our population's increasing, but our dwellings being constructed, that is very low and trending in the wrong direction. We have approvals down and we have commencements down. So you have population rising, population really strong, population growth numbers really high, and no housing supply at the same time. This has been one of the underlying reasons, the structural reason, why the housing market is healthy. If you forget about all the noise, forget about the economy, forget about jobs and things like that, and just go down to basics, like you're going to the supermarket and you want to buy something. You really want to buy bananas, and then all the banana producers go out there being like, we don't want to make bananas anymore, there ain't no bananas. That's basically housing. There ain't enough homes being built, and more people need homes. So when you simplify it into real basics, you see strong housing conditions based on just basic demand and supply. So what do we make of all of this? That's the Sydney housing market, that's the future. Interest rates will change the situation, will help reverse the downward trend and bring it back up. But that could all take a little bit of time. We'll need a bunch of rate cuts that aren't even here yet. That's the real summary, but there's a strong housing demand supply situation saving it all and keeping housing going through this situation. Population growth masking over all of the problems here with the economy. That's really a national economy story at the moment too. But where are the opportunities associated with this? So the broad macro, if I was throwing a dart and I just wanted a capital growth rate, I'd be a little bit hesitant to invest in Sydney purely based on that. A lot of property investors do like dart throwing and just pick any location and be like, boom, that's what I want to invest in. That approach doesn't really work for Sydney at the moment, given everything I've just said. But there are opportunities too. Sydney does have strong housing fundamentals with that demand-supply imbalance that we just talked about. That presents a little bit of opportunities, and then when you deep dive into exactly what, it becomes a little bit clearer. The first thing is Sydney apartments represent value. The spread between apartment costs and house costs is larger than ever, and that really isn't all that sustainable. Part of the reason for that is there has been strong apartment supply in the 2017-2018 period, and that has come through to the market over the last 2-3 years, maybe a little bit longer than that. But now we aren't building enough apartments. We're not building any apartments. And when you go for a drive around and just really simplify it, Sydneysiders will understand this one a little bit. If you drove around over the last 5-7 years, you probably saw cranes in the sky everywhere. Nowadays in Sydney, yeah, you do see it sprinkling around, but it ain't that much altogether. When you compare it to Japan, for example, you barely ever see a crane up there where people are building homes, or Europe. I've been to both of those places, and you barely ever see any housing construction of apartments in most of these developed capitals. Sydney, on the flip side, is just cranes up everywhere. It looks more like Dubai over the last few years, over the last decade, but now it's really wound back and fewer people are building apartments, particularly out across the suburbs of Sydney. That spread in house and apartment prices, along with the fact that there's no unit construction and these downward trend in approvals is driven by a fall in apartment construction and apartment approvals. You're going to see apartments represent value. More and more demand from all these people coming in, no supply. That creates a little bit of a combination for you to look at. And anyone with an existing apartment, that is a little bit of an opportunity. This is great news for first home buyers who typically are skewing towards the apartment sector. Affordable apartments, really good value opportunity of today. I wouldn't say in the long run that is the best capital growth type of asset. Sydney housing will probably continue to outperform Sydney houses over a 10, 20, 30, 40 year window. But right now, 2024 to maybe 2030, there's a little bit of a window of apartments representing value. Good news for first home buyers. The second major opportunity is a function of the New South Wales housing crisis. New South Wales needs to build more homes. They need to upzone land and they need to make it happen pronto. This approach means massive planning reform. We've just had the transport-oriented development plan get into action inside 4 months. 30-odd stations all across Sydney have just been upzoned and allowed more density. The New South Wales government report are saying expand those stations out and add even more housing there. And then the mid-rise housing code is due to kick in at the end of the year, which adds in way more housing supply than TOD itself, which adds more and more housing options for Sydneysiders, or at least changes the zoning of land. So if you own key bits of land, like a house in an area around transport infrastructure or a shopping centre, you're likely sitting on an asset that will change and may perform well as a result. Particularly if you can build higher end apartments that cost more than $800,000-900,000 on them. And the final opportunity is in the premium sector of the housing market. It looks like there's value starting to appear, as crazy as that sounds, but if interest rates keep coming down as expected over the years ahead, and house prices are moving backwards in these areas, that could open up a little bit of a window for these areas, particularly if they also take advantage of the second point that I mentioned with that zoning change. The premium areas do represent areas that could change a little bit more, and that change could present opportunities too. So those are the three main opportunities that are out there available to people, and they target different groups. So you've got the first group of first home buyers looking at apartments. You've got developers and anyone who wants to be a property investor buying specific types of land that will exhibit zoning changes from all the planning changes. And finally, you've got the upgrader market, the $2 million plus market that's showing some signs of value soon. You can see in some pockets, they are going backwards, and that could be a bit of a buying opportunity in these areas. These areas won't go backwards for long. They are very strong demand areas, and that presents an opportunity. So there you have it, full deep dive into the Sydney property market. If you like this video, please do me a favor and hit that subscribe button and that bell notification, and I'll keep producing more and more of these videos for you. This is the first of this series. We're going to be deep diving into every single capital and doing the same analysis for Melbourne, Perth, Adelaide, Brisbane, and releasing that slowly to you.